Look, it was a day ago, right? Canada's inflation rate came in at 4%, which doesn't sound terrible, but of course it's well above what the Bank of Canada wants to see before things begin to stabilize. It's also up, by the way, from 3.3% in July, so that's significant. This time around, the increase largely driven by rising gas prices, but maybe of greater concern, what we're seeing in rent. Rent up 6.5% year over year, the biggest increase we've seen in that category in at least 30 years, not months. David MacDonald is a senior economist at the Canadian Centre for Policy Alternatives. Mr. MacDonald, thank you for being here. I was trying to do a good news, bad news, so I've given the bad news. Is there any good news here in these numbers?
It's cheaper to get a plane ticket. Certainly tourism prices are down a little bit. And certainly when it comes to grocery prices, they're still high on a year-over-year basis, but it's largely due to what happened in November, December, and January, the end of 2022 and the start of this year. That's where we saw big increases in grocery food prices. But since then, they've been fairly moderate. So we're at a higher level, and actually in the past month, we've actually seen grocery store prices on a month-to-month basis drop by about 0.5%. So slightly better news there, but certainly still far above where they were, say, in 2019.
I don't want to talk about gas prices, but I guess we should talk about gas prices. Can we expect things to stabilize and even get better there?
So what we saw was that gas prices fell in July, and so we got some benefit of that in a lower inflation number in the July figures, which came in at 3.3%, and then went back up again in August. And so we are seeing the result of that combined with other things at the 4% level. That's sort of the headline rate. Gas prices have gone slightly higher since then, and so that doesn't bode well for the next data, which will come out, at the end of September. We're sort of 3/4 of the way through the month. That'll be the September data. One of the big issues with gas prices as well as food is, these prices aren't determined here. Interest rate policy has little impact on them. And so whether they're high or low is outside of the control of Canadian governments and the Bank of Canada.
I wonder, so we had the U.S. Fed today come in and not change rates, keep them where they were. That was widely expected. The same thing, I think, can be said of the situation here with the Bank of Canada. We didn't expect a hike, but the banks seem to go out of their way, both here and south of the border, to let us know that, hey, we're not out of the dark here yet. There is a chance of more hikes to come. And now they're talking already about maybe this doesn't moderate to the point where we can start to see drops until sometime next year.
Yeah, certainly the 4% figure was a bit of a surprise. It was certainly higher than expected. I think that if we see another month worth of, a relatively high amount of September data, say over 3.5%, that's going to put us at very high risk of another rate increase in the October 25th decision of the Bank of Canada. There's a decision in October and the decision in December. The other thing that's going on here is that the Bank of Canada actually doesn't follow the headline rate as much as its own measures. It's got these three sort of custom versions of the inflation index that try to strip away some of the more volatile parts of the index. And 2 out of the 3 of those went up in the August data. They've actually stayed well outside of this, 1 to 3 range. In the previous 2 months during the summer, the headline rate flirted with 3%. It was just under 3% in June, just over in July. But the Bank of Canada's custom measures have never been that close, and 2 of the 3 of them went up. So I just think this is really bad news and really sets us up for the potential of not rate decreases, but more rate increases in the fall.
What are those items that you mentioned that we all look at other things, of course. What are the key metrics that the Bank of Canada is looking at?
They have 3 CPI versions that strip out some of the more volatile measures and try to get to what they call core inflation. And so, it strips out things like food and gas, which are quite volatile, and tries to focus in on some of the other measures. And so they think those are better measures of core inflation, and so they follow those more closely. And so if you're seeing those go in the wrong direction, or 2 out of the 3 go in the wrong direction, that is potentially more important than seeing the headline figure go in the wrong direction, although both of those happened in the August data.
So, Mr. MacDonald, I heard you on CTV describing or warning, really, that we were in a dangerous situation here in Canada. And is that because you are anticipating more rate hikes, and how does that make things dangerous, per se?
Well, what's important now is certainly gasoline is playing a part in higher inflation, but so is mortgage payments and rent. And mortgage payments and rent go in the same direction as interest rates. So as interest rates rise, so do mortgage payments. Talk to anybody with a variable rate mortgage. But interestingly, as interest rates rise, so do rent. As landlords see their mortgage costs go up, they try to push those additional costs onto tenants through rent increases. And so the August data showed 6.5% year-over-year increase in rent. That's the highest we've ever seen in this series. The series goes back to 92, so at least 30 years. And so this is the other part of the situation we're in now, is that interest rates are driving critical parts of inflation, particularly when it comes to mortgage interest costs and rent, in addition to, gas and other things fluctuating. We haven't seen any real GDP growth, or any change in real GDP growth, rather, since January. January through July has been dead flat in terms of real GDP growth. So the economy is basically flatlining. What that means is that it doesn't really take very much to push us decisively into the negative category, into potential recession category. And particularly when we're not seeing inflation come down very much. I mean, the bank expected that for the coming months we'd see about 3% inflation and that it would slowly get back to normal. We're not seeing that. We're seeing it go back up to 4%. And that, I think, really sets us up for the potential of more rate increases. Of course, the bank isn't targeting GDP. That's sort of secondary to them. The labor market is secondary. What's primary and front of mind for them is getting that inflation rate back down to 3%, and they're going to do it through interest rates and potentially interest rate hikes. That could now really start to bite as we see, rent and mortgage costs go through the roof.
And it's so weird as I hear you describe that, and people have brought this up as well. You're kind of shooting yourself in the foot as the Bank of Canada, right? You hike interest rates because inflation is still running too hot. Now you end up driving rents up, as you described. You end up driving mortgages up, as you described, which really just feeds inflation even more. It seems like a situation you can't get out of.
Yeah, I mean, what's supposed to happen, this isn't what's happening, but what's supposed to happen is supposed to be an offset. The offset is, yes, mortgage and rent costs go up, but housing costs go way down, and so do the cost of cars, both of things you buy with debt. And so as the mortgage cost or the carrying costs go up for a car loan or a mortgage, people buy a lot fewer houses, buy a lot fewer cars. We have seen house prices come down a bit, but it's not like we're not even close to where we were even in 2019 pre-pandemic. So we're just not seeing that sort of leverage kick that you'd expect on the housing side. We're not seeing it on the vehicle side either because of the huge shortage of vehicles. Mm-hmm. Vehicle prices are still going through the roof, even though to carry that cost through a car loan is very expensive. So you're not getting that trade-off that you'd otherwise expect. You're just getting the cost side without the decrease in prices.
Well, glad we were able to give everybody some wonderful news today of what to look forward to. Mr. MacDonald, I thank you so much. We appreciate your time.
Thanks for having me.
David MacDonald from the Canadian Centre for Policy Alternatives. Not a whole lot of green lights in there, huh?